People like Ray Dalio or Michael Burry were highly profitable during a period where most people are scared about their finances and fear dominates the markets. These periods are recessions, and they did this by being a step ahead and paying attention to things that most people ignored. Today, I want to share with you a metric that, in some cases, could help predict scenarios like this months or even years before they actually happen, so you can take your provisions earlier. This metric is known as the yield curve. And to understand it, it's very important you also understand how the debt market works, more specifically, the bond market. Even if you don't invest in bonds, remember this market is not only bigger than the stock market but also crucial for the economy. So it is very important you're familiarized with it because changes in it can also impact the equities market such as stocks. If you're not familiar with bonds, I recommend you to watch my video on the topic first because it will make you understand the yield curve a lot easier. You'll also find it in the description below. That being said, let's get into today's topic. So, what is the yield curve? This is a graph that before the 80s, you could have considered just another metric, but then people started to realize patterns on it that could help with forecast of future economical activity. So, they started to see this as a leading indicator of the market. What this graph shows us is a comparison of the yields that different bonds that share the same risk but different maturities have over time. You might take corporate bonds, for example, from different businesses that have the same creditworthiness, so they have the same risks. But these bonds will mature in different times. Some might be bills that expire within months, others notes that have a maturity from 1 to 10 years, or bonds with a maturity of over 10 years. When you hear investors and journalists referring to the yield curve, though, it's most likely a graph that contains treasury bonds issued by the federal government. Since they're issued by the same entity, they have the same risk, and you can compare the yields they pay or the interest they paid in the secondary market for the different maturity dates that they have. This is what you would call a normal shape in a good economical environment, where shorter-term treasuries of say 2 years have a lower yield than long-term ones with more time to maturity. And if you think about this, this is theoretically logical. When you lend money, usually the longer that you have to wait to get your money back, the more interest you will demand, and the sooner you're repaid, the less you will receive on interest. However, this indicator can take two other different forms that might, in some cases, be concerning about the future of the economy. It can either become flat or even get to a point where it's inverted. Considering the same principle we saw before, this would mean that investors are either getting the same yield or being paid at the same rate for short-term and long-term bonds. Or, in case of an inversion, that creditors with short-term bonds get paid more than those who lend their money for a longer period of time, which also means that for bond issuers, in this case the government, new short-term debt will be more expensive than long-term debt. Now, that doesn't really make much sense, does it? Let's go over what causes this and also why is it concerning. Let's focus on each end of the indicator. We'll call this the short end, and this one the long end. The short end is highly impacted by central banks, in case of the United States, the Fed, or in case of the United Kingdom, for example, the Bank of England. Whereas the long end is more impacted by the supply and demand on the bond market, often created by speculation. Since this shows the yields that bond paid in the secondary market as they are traded among investors, it is also a good reflection of the consensus sentiment towards the market and their expectations about forecasted interest rates or possible future scenarios. Let's explain this in more detail. When the economy is going too fast, and people are spending a lot, and corporations are also borrowing too much, too fast, the Federal Reserve, in order to slow things down and in an effort to keep inflation at low levels, ideally around 2 to 3% a year, might start tightening their monetary policy, meaning they make an increase on interest rates. This will slow down the economy. And while it might sound like something you want to avoid, in this case, that is exactly the goal. When there are higher interest rates, people will be a lot more conservative about their money, and spending will slow down. In a high interest rate environment, commercial banks will increase their rates to lend money to people, so they will think twice before getting a loan. But this not only affects consumers and households, but also corporations. Issuing bonds or raising capital through debt will no longer be attractive, as they will need to pay a higher cost for that capital. They might also make some changes to protect their cash flows and margins, like layoffs, for example. Usually, when a society is under this type of economical environment, they spend less on both a consumer and a corporate level, therefore slowing the pace of inflation. And because of this conservatism towards money, businesses will also avoid increasing the price of their products and services because of the lower demand. So, in a nutshell, an increase on interest rates will slow everything down like a chain effect. This will, of course, not have an immediate effect in the economy. So it's not like they increase them today and everything slows down immediately. Because you need some time for consumers and corporations to change their behavior and actually see the impact of the new monetary policy in the economy. You also need to consider the existing bonds with fixed rates that still have some time ahead to mature. So corporations need to settle the debt on those ones. Therefore, you might not see a spending slowdown but until a year or maybe a couple years after. So central banks like the Fed usually work based on forecasts, as these changes will not have an immediate noticeable impact. Now, let's take a look at our yield curve indicator to see how this will affect it. And let's first only focus on the short end of the yield. Remember that when interest rates increase, this will decrease the value of the outstanding bonds, and by decreasing it, the yield they pay will be higher relative to their new and lower par value. This will of course affect you only if you want to resell your bond before maturity. If you want to hold it instead, this will be meaningless to you. So on the one hand, you'll have people who own bills that are very close to their maturity date, meaning they will be paid the entire face value in the near future. So they will not be really interested in selling their treasury bills at a discount, but instead they will wait for them to mature and get their principal so they can reinvest it at the higher rate. So this side of the short end might not have a lot of activity but until later. On the other hand, as you go further into their maturities, you might find people that are actually willing to sell them at discounts, therefore increasing their yields. And this is because these bond holders will have to wait longer to get their principal and be able to reinvest at the new and higher yield. So this side might start increasing a little, but it won't be too long before the very short end starts increasing as well, either because those bonds start maturing or newly issued bonds start being sold at the higher rate. So in a nutshell, an increase on interest rates will decrease the value of outstanding bonds and therefore make their yields higher, causing the short end to move up and our indicator to flatten a little. Conversely, when interest rates decrease, bonds increase in value and their yields are smaller, and the chart might go back to its normal shape. So that is why this short end moves up or down. Now let's focus on the long end, and things here get a little more interesting. So it's important you know that changes in monetary policy will affect all bonds if you're planning to resell it, even the ones with maturities up to 30 years. Because by definition, when interest rates increase, bonds decrease in value and their yield goes up. And when interest rates decrease, bonds increase in value and their yield goes down. So based on that, why doesn't the same thing that happens in the short end also happens in the long one? I mean, if there are high rates, people will start selling them because they have to wait a long 30 years to be able to get their principal. So if they sell them at discounts, their yields should go up. So why doesn't this end also move even higher? And that is why I mentioned that on this side, monetary policy or central banks have very little effect compared to supply, demand, and speculation. in the current economical environment can be used to create a speculation. When interest rates are at a good level, not too high to hurt bond issuers and not too low to create uncontrolled spending, the yield is usually normal. There might not be a lot of demand of long-term treasuries because since the economy is booming, people prefer to invest their money in other assets like stocks that can provide them higher returns. However, it all starts to change with the speculations, as rumors spread that might or might not be true or accurate. If, for example, current interest rates are too high and people are expecting a recession, this is what will happen to our indicator. Because of the high interest rates, our short end will move up. But what happens to the long end? Well, it might start going down, flattening the graph, or also creating the inversion. How so? Well, let's think about it. During a recession is when people and corporations are the most careful about spending, when there is more unemployment and the economy is not growing. During recessions, the Fed is expected to do the opposite, to lose their monetary policy by decreasing their interest rates severely to try to encourage spending and boost the economy. So if you think a recession is coming, so you believe interest rates will decrease a lot, the debt market might seem like a safer place than the equities market. This means that some people might take their money out of stocks and other investments that represent a higher risk, because in a recession, companies will most likely underperform and you'll lose money in the stock market. And they might put their money in a more reliable and safe place like treasuries, ideally with longer maturities. Also, they will be willing to pay higher face values for long-term bonds in order to lock in current yields, so long-term treasuries will have a high demand. Thus, in case the recession is actually taking place, you have your money in a safer place that additionally gives you a higher yield that you locked in, basically because you bought it before interest rates went down. And of course, the treasury bond itself will be a lot more valuable the lower interest rates go during the recession. So what does it all look like in our chart? Well, a higher demand on long-term treasuries will increase their values, and the higher their values, the lower their yields will be. And if people keep buying them over and over, is when the inversion happens. This is basically the market saying that they believe an unfavorable economical environment might take place soon, and that they prefer to secure their money in safe assets for a long period of time to be more conservative. So they're willing to pay high prices for lower yields that will last longer than lower prices for higher yields in the short term. You might be wondering, if the yield is inverted because people expect a recession, why don't they just start to buy short-term debt? So basically they take advantage of the fact that everyone's focused on long-term treasuries to buy short-term bills, and they take advantage of their higher yields in a shorter period of time. And the reason is that by doing so, they face a much higher reinvestment risk. Usually, what bond investors do is they reinvest their principals when they're returned to them on maturity. So they put their money to work for them because of the interest it creates. Of course, they get excited by high interest rates because that money will basically generate more money. But sometimes, especially during an inversion, choosing a lower yield today to lock it in for a long period of time is a smarter move than choosing higher yields in the short term. Say there are two investors. One buys a 20-year treasury that pays 4% return, and the other buys a 1-year note that pays 5% return. We can assume there's an inversion here because the short end has higher rates than the long one. If a recession actually takes place, and say a year after the Fed suddenly brings interest rates down to 2%, the first investor will still be paid 5% for the next 19 years because he locked in that rate for 20 years when he bought it initially. Not to mention that now his treasury is a lot more valuable if he wanted to resell it. Meanwhile, the second one, when he wants to reinvest, he will either have to buy a new bond with a lower 2% rate or buy a bond with higher returns, but he will have to pay a premium for it. Now, let's go to real-life cases. Let's take a look at how this indicator has behaved during some recessions in the US, for example. Before we do it, it is worth mentioning that if it flattens or inverts, this doesn't mean that you are immediately in a recession. It might never arrive or might take some months or even a couple of years after the inversion for it to start. Let's take the last couple recessions, the Great Recession in 2008 and the pandemic in 2020. When it comes to the pandemic, around September 2019, there was an inversion in the yield curve before that recession arrived. It was a really short recession because a lot of things helped fight it, like lowering interest rates down to zero and remote jobs that, in a way, not only helped some job positions but also reducing costs for companies without affecting their operations. There was an inversion also before the Great Recession. You can see, for example, here on January 2007, 30-year treasuries were paying a lower yield than 1-month bills. This pattern has also been seen in the graph with previous recessions, like the one in the early 2000s, for example. And every other recession the US has had in the last 40 years has been preceded by an inversion in the yield curve. Now, I didn't want to make this video too long and wanted to focus on giving you an explanation on how this graph works, why both ends of the metric move and what causes these moves, but most importantly, what can you interpret from it. But a question you might have right now is, what does the curve look like today?
Well, by the time I'm recording this video in mid-2026, it is actually not inverted, and it came from one of the biggest inversions it had back in 2023. It hadn't inverted this much, not even since the Great Depression. But most experts classify that as a false indication of a recession back then, and it seems like they were right. In 2026, you can see it is normally shaped.
Thank you so much for watching this video. You'll get new videos in this channel every week, so you can turn on the notifications and also subscribe to stay updated. See ya!